Your grocery bill, your heating costs, the diesel that moves every product you buy, all of it just became exponentially more volatile. And the mechanism designed to prevent catastrophic price swings just confirmed it can no longer contain what's coming. On January 27, 2025, the commodity futures market experienced the largest single-day value destruction in its recorded history. Over $420 billion in notional value evaporated in less than 7 hours of continuous trading. Not gradually, not across weeks of selling in one session. Within 48 hours, the Chicago Mercantile Exchange raised margin requirements on crude oil, natural gas, and agricultural futures by an average of 34%. The last time they implemented emergency margin increases of this magnitude outside of federal policy intervention was October 2008, 6 days before Lehman Brothers collapsed. This type of move has only occurred 4 times in the past 50 years. Each time, it preceded a systemic breakdown in credit markets, not commodity markets. The breakdown always begins where no one is looking. The question isn't whether this was an anomaly. The question is, what fails first when the world's deepest, most liquid risk transfer system starts rejecting participants? I'm John A.G., and this is the Collapse Files. Between market open on January 27th and settlement at 14:30 Eastern Time, the Bloomberg Commodity Index fell 11.2%. In dollar terms, the total notional value of open interest across CME energy and metals contracts declined by $422 billion. To contextualize that figure, it represents more value destruction than the entire annual GDP of Norway. This was not a single commodity breaking. This was coordinated, simultaneous collapse across unrelated asset classes. West Texas. Intermediate crude fell 18.3% intraday. Natural gas dropped 23.7%. Copper declined 14.1%. Even soybeans, historically uncorrelated with energy during non-drought periods, fell 9.4%. The velocity matters more than the magnitude. Crude oil moved through 6 standard deviations in under 4 hours. In statistical terms, that kind of move should occur once every 1.4 million trading days, or roughly once every 5,600 years. It happened on a Monday. By Wednesday, January 29th, the CME group issued revised margin schedules across 17 commodity contracts. Crude oil initial margins increased from $6,200 per contract to $8,400, a 35.5% increase. Natural gas margins rose from $3,850 to $5,100, a jump of 32.5%. Corn, wheat, and soybean margins all increased between 28 and 31%. These aren't minor technical adjustments. Margin requirements exist to ensure participants can cover potential losses. When the exchange raises them this aggressively, it's signaling one thing. The risk models that govern the system no longer trust recent price history to predict tomorrow's volatility. Here's what that means in mechanical terms. A speculator holding 10 crude oil contracts at the previous margin would have needed $62,000 in their account. Under the new rules, that same position requires $84,000. If they don't deposit the additional $22,000 within hours, the position is liquidated automatically. Multiply this across thousands of participants, and you create a forced selling cascade that has nothing to do with supply, demand, or fundamentals. The last time the CME raised margins this quickly outside of a geopolitical oil shock was October 2008. On October 9th, they increased crude margins by 31%. 6 days later, Lehman Brothers was insolvent. 3 weeks later, the entire commercial paper market froze. That sequence wasn't coincidental. Margin calls act as liquidity drains. They force selling in the most liquid markets first: commodities, treasuries, currency futures, because those are the only assets that can be sold fast enough to meet cash demands. The underlying businesses, the corporate bonds, the private credit, those freeze. But commodities move in milliseconds, so they get hit first. What happened on January 27th wasn't a commodity story. It was a liquidity story that expressed itself in commodity prices, because that's where liquidity is measured in real time. The CME's response confirms this. They didn't raise margins because oil fundamentals changed. They raised margins because volatility exceeded their risk tolerance, which means the models governing trillions in notional exposure are now operating in regimes they weren't designed for. And here's the part that separates this from prior volatility spikes. Open interest didn't collapse. Normally, when prices fall this hard, traders exit, contracts get closed, open interest drops. But in this case, open interest across energy contracts fell by only 4.7%. That means most participants are still in the market. They're just trapped at massive losses, unable to exit without triggering further liquidations. This is the setup, not the crisis. The setup. Commodity futures markets exist to transfer risk. A farmer wants to lock in the price of wheat before harvest. A refinery wants to guarantee diesel costs 6 months forward. Futures contracts let them do that. The exchange acts as the intermediary, guaranteeing both sides of every trade. To ensure those guarantees hold, the exchange requires collateral, called margin. If you want to control 1,000 barrels of oil, you don't pay for 1,000 barrels up front. You post margin, typically 5 to 10% of the contract's notional value. If the trade moves against you, the exchange demands more margin. If you can't post it, your position is closed. This system works smoothly when volatility is predictable. The exchange calculates margin requirements using historical volatility models. If oil typically moves 2% per day, they set margin high enough to cover a 4 or 5% move. The buffer exists to prevent defaults. But when volatility exceeds the model's assumptions, the exchange has two choices: accept the risk of participant defaults or raise margins immediately. They always choose the latter. Here's the critical mechanism most analysts miss. Margin increases don't reduce risk, they redistribute it. When the CME raises crude margins by 35%, every participant holding a position must either deposit more cash or sell. Most don't have the cash, so they sell. Those sales push prices lower. Lower prices trigger more margin calls. More margin calls trigger more forced selling. This is a reflexive loop, and it doesn't care about fundamentals. In normal markets, this loop is broken by value buyers, hedge funds, commodity trading advisors, sovereign wealth funds, who step in when prices disconnect from intrinsic value. But in January 2025, those buyers didn't appear. Open interest stayed elevated, meaning positions weren't transferred to new hands. They were simply held at losses. That tells us something crucial. The buyers who normally stabilize these markets either don't have the capital, don't trust the clearing system, or are themselves facing redemptions. Now, who is trapped? First, the commodity trading advisors. CTAs manage roughly $380 billion in trend-following strategies. When trends break violently, these funds don't have discretion. They follow their models. Most CTA models would have triggered exit signals across energy and metals on January 27th. But exiting a $50 billion position in a falling market accelerates the decline. They're trapped between their risk mandates and the mechanical reality of selling into a void. Second, the leveraged producers. Small and mid-sized oil producers hedge future production using futures contracts. When prices collapse, those hedges pay out, but only if the counterparty can meet margin. If the producer is also facing margin calls on other positions, or if their credit lines are tied to commodity prices, they face a cash flow crisis despite being hedged. The hedge works in theory, but liquidity determines whether it works in practice. Third, the pension funds and insurance companies that sold volatility. For the past decade, institutional investors have been systematically selling commodity volatility, collecting premiums by writing options on oil, gas, and metals. When realized volatility exceeds implied volatility by the margins we saw on January 27th, those short volatility positions generate massive losses. And because those positions are often buried in absolute return or risk parity mandates, the losses surface weeks later hidden in quarterly reports. The system is designed to function when participants are diverse, liquid, and capitalized. It fails when participants are homogeneous, illiquid, and leveraged. January 27th revealed we're in the latter regime. The CME's margin increase isn't a fix, it's an admission that the clearing system is now prioritizing its own solvency over market stability. And when the world's largest derivatives clearinghouse starts behaving defensively, it's signaling that the participants it clears for are no longer creditworthy under current volatility assumptions. This is the opposite of what the system is supposed to do. Clearinghouses exist to absorb risk during stress. Instead, the CME is rejecting it, pushing risk back onto participants who are least able to bear it. That's not a market correction. That's a structural breakdown. Let's examine the numbers that matter. The Bloomberg Commodity Index fell 11.2% in one session. The previous record single-day decline was 9.7%, recorded on March 9th, 2020, during the COVID lockdown panic. But here's the distinction. In March 2020, the decline was driven by demand destruction. Economic activity stopped. In January 2025, there was no equivalent catalyst, no war, no lockdown, no supply shock, just selling. That tells us the move was technically driven, not fundamentally driven. And technical moves of this magnitude require massive coordinated liquidation. The notional value decline of $422 billion must be understood in context. Total global commodity, open interest across all exchanges, is roughly $14 trillion. A $422 billion decline in one day represents a 3% reduction in total notional exposure. That might sound small, but consider this. During the 2008 financial crisis, total commodity open interest fell by 18% over 6 months. We just witnessed a comparable rate of decline compressed into 7 hours. Now let's analyze crude oil specifically. On January 27th, WTI crude opened at $72.40 per barrel and reached an intraday low of $59.15. That's a 13.25 decline, or 18.3%. Each WTI contract represents 1,000 barrels. A trader holding one contract lost $13,250 in one day. If they were holding that contract on the previous margin requirement of $6,200, their loss exceeded their posted collateral by 113%. This is why the CME raised margins. Under the old margin, a single day's move could wipe out a participant's equity and create a deficit. That deficit becomes the clearinghouse's liability. The CME raised margins to ensure that even if volatility persists at these levels, participants can't create deficits that threaten the clearing system. But here's the feedback mechanism. Raising margins from $6,200 to $8,400 means anyone holding crude contracts must deposit an additional $2,200 per contract immediately. A medium-sized hedge fund holding 1,000 contracts must deposit $2.2 million in cash within 24 hours. If they don't have it, they sell. Those sales push crude lower, triggering another round of margin calls. Natural gas exhibited even more extreme behavior. The prompt month contract fell from $3.84 per MMBtu to $2.93, a decline of 23.7%. Natural gas is already the most volatile commodity in the energy complex. Its 30-day realized volatility averaged around 60% annualized, but a 23.7% single-day move implies annualized volatility of over 400%. No model prices that risk accurately. The cross-asset correlation breakdown is equally significant. Crude oil and copper typically maintain a 30-day rolling correlation between 0.5 and 0.7. They move together because both are industrial inputs. On January 27th, that correlation spiked to 0.94. When correlations approach 1.0 during a sell-off, it indicates indiscriminate liquidation. Participants aren't making fundamental distinctions. They're selling whatever they can, as fast as they can. Agricultural commodities followed the same pattern. Soybeans fell 9.4% despite zero fundamental justification. Weather patterns were normal. Chinese import data showed no deterioration. There was no reason for soybeans to fall in sympathy with crude oil, except forced selling. Here's the ratio that matters most. The crude oil futures curve went from a contango of $1.20 per barrel, February over March contracts, to a backwardation of 0.85 in under 3 hours. That's a 2.05 swing in curve structure. Curve inversions of this speed don't reflect supply tightness. They reflect liquidity, desperation. Sellers are dumping prompt contracts at any price because those are the most liquid. Deferred contracts trade less frequently, so they hold value longer. The result is an inverted curve that signals nothing about physical markets and everything about financial stress. The volume to open interest ratio provides further confirmation. On a normal trading day, crude oil volume runs about 1.2 times open interest, meaning the average contract trades 1.2 times. On January 27th, that ratio hit 3.8. Contracts were changing hands nearly 4 times in a single session. That's not hedging, that's panic. Finally, examine the margin increase itself. A 35.5% increase in crude margins is the third largest emergency adjustment in CME history. The largest was a 47% increase on October 16, 2008. The second largest was a 41% increase on August 8, 2011, during the U.S. debt ceiling crisis. Both preceded severe credit market dislocations within weeks. The CME doesn't raise margins to punish speculators. It raises margins when its risk models indicate that current volatility regimes exceed the collateral coverage necessary to prevent clearing failures. This is a defensive move by an institution that exists to guarantee trillions in derivative exposure. When it acts defensively, it's because the participants it clears for have become untrustworthy. Every number here points to the same conclusion. This was not a commodity sell-off. This was a liquidity event that happened to express itself in commodity prices first. The playbook for what follows has been written 3 times in modern financial history. The first was October 1987. On October 19th, the S&P 500 fell 20.5% in a single session, still the largest one-day percentage decline in U.S. equity history. But the crisis didn't begin in stocks. It began 2 weeks earlier in currency futures. The U.S. dollar had been falling against the Deutsche Mark and Japanese yen for months. On October 6th, the CME raised margin requirements on currency futures by 33%. That margin increase forced leveraged players to liquidate positions across all asset classes. Portfolio insurance algorithms, the 1987 equivalent of today's volatility targeting funds, triggered automatic selling in equity futures. That selling overwhelmed market maker capacity, and the cascade fed on itself. The lesson: margin increases in one market force liquidations in others. The 1987 crash wasn't caused by currency margins, but currency margins exposed the leverage and interconnectedness that made the crash inevitable. The second precedent was 1998. Long-term capital management, a hedge fund managing $4.6 billion in equity, controlled over $125 billion in assets through leverage. LTCM was heavily positioned in commodity spreads, betting on mean reversion between similar contracts. In August 1998, Russia defaulted on its debt. Global risk appetite collapsed. Commodity spreads widened violently. The CME and other exchanges raised margins across energy and metals contracts by an average of 28%. LTCM couldn't meet the calls. The fund was forced to liquidate, and those liquidations destabilized treasury, mortgage, and swap markets, none of which had direct Russia exposure. LTCM's collapse revealed a structural truth. Commodity markets aren't isolated. They're collateral for leverage everywhere else. When commodity margins rise, leverage participants must delever across all positions, not just commodities. In 1998, the Federal Reserve organized a bailout, not because they cared about LTCM, but because LTCM's counterparties, the major investment banks, were about to face cascading collateral shortfalls. The third and most relevant precedent was 2008. In early October, oil prices were collapsing from $145 per barrel in July to under $70 by October 9th. The CME raised crude oil margins by 31% on October 9th, citing unprecedented volatility. 10 days later, Lehman Brothers filed for bankruptcy. But Lehman's failure wasn't caused by oil. It was caused by a commercial paper market freeze. And that freeze was caused in part by commodity margin calls, forcing institutions to hoard cash. Here's how the mechanism worked. Major financial institutions held commodity positions as part of diversified portfolios. When margins increased, they needed cash immediately. The fastest way to raise cash was to stop rolling over commercial paper, short-term corporate debt. Companies that relied on rolling over commercial paper to fund daily operations suddenly couldn't. Credit froze. Lehman, which was heavily reliant on short-term funding, couldn't meet its obligations. The commodity margin increase didn't cause Lehman's failure, but it accelerated the liquidity drain that made failure inevitable. In all three cases, 1987, 1998, and 2008, the pattern was identical. Extreme volatility in one market. Emergency margin increases, forced liquidation across unrelated markets, credit market freeze, systemic intervention. We are currently at step 2. The difference this time is scale. In 1987, global derivatives notional was roughly $1 trillion. In 1998, it was $80 trillion. In 2008, it was $600 trillion. Today, it exceeds $1 quadrillion. The leverage embedded in that system makes 2008 look quaint. The other difference is central bank capacity. In 1987, the Fed had unlimited room to cut rates and inject liquidity. In 1998, rates were at 5.5%, providing ample space. In 2008, rates started at 5.25% and were cut to zero. Today, rates are at 4.5%. Inflation remains above target, and central bank balance sheets are still bloated from prior interventions. The tools that worked before are either exhausted or politically constrained. History doesn't repeat, but the mechanics do. And the mechanics say, when the largest commodity clearinghouse in the world raises margins this aggressively, the stress isn't in commodities. It's in the balance sheets of the institutions using commodities as collateral. Those balance sheets are now unwinding. The only question is how fast. The mainstream narrative will frame this as a commodity correction. Analysts will point to oversupply in crude, mild winter weather, reducing natural gas demand, or Chinese economic weakness, dampening copper consumption. Those explanations sound reasonable. They're also irrelevant. Fundamentals don't move markets 18% in one day. Liquidations do. Here's what the conventional analysis misses. The commodity market isn't just a price discovery mechanism for physical goods. It's the collateral base for the entire financial system. Banks hold commodity futures as liquid reserves. Hedge funds use commodity positions to margin other trades. Sovereign wealth funds park capital in commodity indices as inflation hedges. When commodity prices collapse this violently, the collateral value supporting trillions in other positions evaporates. That collateral evaporation triggers margin calls in markets that have nothing to do with oil or copper. A pension fund holding a diversified portfolio might be long equities, bonds, and commodities. If the commodity allocation falls 11% in one day, the fund is suddenly underallocated to its mandate. It must rebalance, selling bonds or equities to buy commodities. But if it's also facing redemptions, it can't rebalance. It just sells everything. This is the second order effect no one discusses. The commodity sell-off doesn't stay in commodities. It forces selling in every asset class held by participants who use commodities as collateral or as part of a balanced mandate. The other dynamic that gets ignored is regulatory incentive. The CME Group is a publicly traded company. Its fiduciary duty is to shareholders, not market stability. When volatility spikes, the CME faces a choice: maintain lower margins and risk clearing failures that could bankrupt the exchange, or raise margins and force participants to absorb losses. They always choose the latter. This isn't a conspiracy. It's a rational response to regulatory capital requirements, but the consequence is profound. By raising margins, the CME is rejecting risk precisely when participants most need the system to absorb it. This turns the clearinghouse from a shock absorber into a shock amplifier. The narrative control aspect is equally important. Central banks and financial regulators have spent 15 years convincing markets that the system is resilient, that leverage is monitored, that tail risks are managed. A $422 billion single-day commodity collapse contradicts that narrative. So the story gets framed as a technical correction, a volatility spike, an anomaly. The alternative, that the financial system is far more fragile than advertised, can't be admitted until it's undeniable. This is why official commentary after January 27th focused on orderly markets and normal clearing operations. The CME issued a statement emphasizing that all margin calls were met and no participants defaulted. That's technically true, but it's also misleading. Margin calls were met because positions were liquidated. The absence of defaults doesn't mean the system is healthy. It means participants were forced to realize losses before those losses became defaults. The real signal is in what's not being said. No central bank has issued calming statements. No regulator has announced investigations into manipulation or disorderly trading. The silence is tactical. Acknowledging the severity would validate concerns that the system is unstable. So the strategy is to let the event pass, hope volatility subsides, and move on. But volatility doesn't subside when the underlying leverage hasn't been cleared. It compounds. Here's the incentive structure that guarantees more instability. After a violent sell-off, leveraged participants don't increase risk. They reduce it. CTAs cut position sizes. Risk parity funds de-lever. Pension funds shift to cash. That collective de-risking reduces liquidity in every market. Reduced liquidity makes future volatility spikes more likely, which triggers more de-risking. This is a death spiral, and it doesn't reverse until forced buyers, central banks or sovereign funds, step in. We haven't seen those buyers yet. The final piece most people miss is timing. January is when hedge funds reset risk budgets for the year. It's when pension funds rebalance after year-end performance. It's when corporate treasurers review hedging strategies. A volatility event in January has 12 months to compound through the system. The same event in November gets absorbed over year-end and reset in January. Timing matters. And this happened at the worst possible time. What most people are watching is commodity prices. What they should be watching is who's selling, why they can't stop, and what breaks when they run out of things to sell. This signal isn't about commodities. It's about confidence in the clearing system, liquidity in funding markets, and the leverage still embedded in strategies everyone assumes are safe. When the CME raises margins by 35%, it's stating that recent history is no longer a reliable guide to future risk. The models are wrong. The assumptions are broken. And the participants those models cleared yesterday might not be clearable tomorrow. That's a crisis of confidence in mathematical terms. And confidence crises don't stay contained, they spread. The first thing that breaks is commercial paper. Corporations fund daily operations by issuing short-term debt that's rolled over continuously. When commodity margin calls drain cash from financial institutions, those institutions stop buying commercial paper. Corporations that can't roll over their debt face immediate liquidity crises, even if their underlying businesses are healthy. This is what happened to Lehman. It's what happened during COVID in March 2020. And it's what happens every time a liquidity shock hits the system. The second thing that breaks is cross-currency funding. Global trade is financed through dollar-denominated loans, even when neither party is American. When dollar liquidity tightens, because institutions are hoarding cash to meet margin calls, the cost of accessing dollars spikes. This shows up in cross-currency basis swaps, which measure the premium for swapping euros or yen into dollars. When that premium rises sharply, it signals dollar scarcity, and dollar scarcity freezes global trade. The third thing that breaks is money market funds. Retail investors treat money market funds like cash, but money market funds invest in commercial paper, repurchase agreements, and short-term corporate debt. When those markets freeze, money market funds break the buck. Their net asset value falls below $1 per share. When that happens, retail investors panic and withdraw. The 2008 crisis went critical when Reserve Primary Fund broke the buck on September 16th. Within 48 hours, $150 billion fled money market funds, forcing emergency Federal Reserve intervention. We're not there yet, but the mechanics are identical. Commodity volatility drains liquidity. Liquidity drains freeze funding markets. Funding market freezes trigger money market runs. Money market runs force central bank intervention. The warning the signal delivers is simple. The system is operating with no margin for error. Literally. The clearinghouse just told us that participants can't be trusted to post collateral under current volatility assumptions. If volatility increases from here, and forced selling suggests it will, then the next margin increase won't be 35%. It will be 50 or 60%. And at those levels, even well-capitalized participants start to fail. The historical pattern is unambiguous. Emergency margin increases precede credit market failures by weeks, not months. In 1987, it was 2 weeks. In 2008, it was 6 days. The lag exists because margin calls take time to cascade through the system. Participants exhaust credit lines first. Then they liquidate liquid assets. Then they default. We are somewhere in that sequence right now. The commodity collapse on January 27th wasn't the crisis. It was the stress test. And the clearinghouse just announced that much of the system failed it. What happened on January 27th, 2025 will be remembered as a footnote or a catalyst. The outcome depends entirely on what happens in the next 30 days. If volatility subsides, if participants meet margin calls without further forced selling, if liquidity returns to funding markets, then this becomes a historical curiosity, a violent but contained event that tested the system and found it resilient. But if volatility persists, if the next wave of liquidations begins before balance sheets have recovered from this one, if commercial paper spreads widen or money market funds face redemptions, then January 27th becomes the date when the current cycle peaked, not in price terms, in confidence terms. The CME's decision to raise margins this aggressively tells us the clearing system no longer trusts its own participants under current conditions. That's not a market call. That's a structural assessment. And structural assessments don't reverse quickly. The leverage that built up over 15 years of low rates and quantitative easing doesn't unwind in one session. It unwinds in stages. The first stage is commodity liquidation. We just saw that. The second stage is credit market stress. The third stage is forced central bank intervention. We're between stages 1 and 2. The signal is clear. The mechanics are known, the historical precedents are documented. What remains unknown is whether policymakers recognize the urgency, whether they have the tools to respond, and whether the political environment allows them to act before the liquidations become defaults. The commodity market didn't collapse because of supply and demand. It collapsed because the financial structures built on top of it couldn't bear their own weight. Those structures are still standing, but the foundation just cracked. And when foundations crack, the question isn't whether the building falls. The question is how much warning you get before it does.